Your retirement account is quietly buying SpaceX stock right now, and you never signed off on it. Not a typo. If you have a 401k, that's a tax-advantaged retirement savings account your employer helps you fund, and it holds anything from Fidelity or Alphabet, you already have skin in this game. The Fidelity Contra Fund alone holds $2.7 billion in private SpaceX shares. And on June 12, 2026, SpaceX goes public. Ticker SPCX. Exchange NASDAQ. Target valuation $1.75 trillion. To put that in perspective, that's more than Boeing, Lockheed Martin, and Airbus combined, 3 times over. But here's the thing nobody is talking about. SpaceX lost $4.28 billion in a single quarter. One quarter, and they want you to value them at $1.75 trillion. So today, we're going to answer the only question that matters. Should you actually buy this? Not the hype version of that question. The real math version. Let's start at the beginning, because this story is genuinely insane. In 2002, SpaceX was worth $122 million. That's the price of a nice apartment building in Manhattan. By 2008, they were almost bankrupt. 3 Falcon 1 rockets had failed consecutively, and Elon Musk had spent nearly his entire fortune from the PayPal sale. Then 2 things happened on the same week in December 2008. Peter Thiel's Founders Fund wired $20 million into the company, and NASA handed them a $1.6 billion contract. That was the moment SpaceX stopped being a vanity project and started being a business. By 2015, Google and Fidelity co-invested $1 billion in a single round, pushing the valuation to $12 billion. By 2021, a single funding round valued them at $74 billion. By early 2025, private markets were saying $350 billion. In July 2025, an internal employee share sale priced them at $400 billion. Then, in December 2025, insiders sold shares at $421 each, implying an $800 billion valuation. And then something completely unexpected happened. On February 2, 2026, SpaceX and xAI, Elon Musk's AI company, announced a merger. The combined entity was valued at $1.25 trillion. 3 months later, SpaceX filed its S-1. That's the legal document a company files with the SEC before going public, targeting a valuation of $1.75 trillion. From $122 million in 2002 to $1.75 trillion in 2026. That is a 14,000x return in 24 years. If you had invested $10,000 in SpaceX's Series A, it would be worth $140 million today. But you couldn't, because SpaceX never let regular people in until now. So when we say $1.75 trillion, what are we actually buying? SpaceX as a public company is not just a rocket company anymore. After the xAI merger, the S-1 filing shows 3 business segments: space, connectivity, and AI. In 2025, total consolidated revenue was $18.674 billion. The space segment, rockets, launches, NASA contracts, brought in $4.086 billion. But here's the number that makes everything else make sense. Starlink, the satellite internet service, brought in $11.387 billion. That's 61% of total revenue. And xAI, which includes the Grok AI assistant and the X platform, added $3.2 billion. So when you buy SpaceX stock, you're not really buying a rocket company. You're buying a satellite internet company that also has a rocket company, and apparently now also a social media platform. Okay, let's talk about Starlink, because this is where it gets interesting. As of March 2026, Starlink has 10.3 million paying subscribers. That's roughly the population of Sweden. It operates across 164 countries, territories, and regional markets. It controls 97.1% of all global satellite internet traffic, not satellite broadband in the U.S., satellite internet on Earth. 97%. The competition is basically irrelevant. Viasat has 157,000 subscribers. HughesNet has 783,000. Amazon's Project Kuiper, which is supposed to be the big rival, hasn't launched a single commercial satellite yet. But here's the data point that changes the story. Starlink's average revenue per user, the monthly fee each subscriber pays, has been falling every single year. In 2023, the average subscriber paid $99 a month. In 2024, that dropped to $91. In 2025, it dropped to $81. By Q1 2026, it had dropped to $66. That's a 33% decline in 3 years. SpaceX's answer? We're doing this on purpose. They're cutting prices aggressively in international and emerging markets to build the subscriber base as fast as possible. The logic is, get the volume first. Worry about margins later. And to be fair, the math is still working. For now, Starlink's operating margin in 2025 was 38.8%. The segment generated $7.168 billion in adjusted EBITDA. That's earnings before interest, taxes, and non-cash items, essentially the cash profit a business generates. That's a 62.9% EBITDA margin. For context, Apple's EBITDA margin is around 35%. Starlink is, by that measure, more profitable per dollar of revenue than Apple. If you valued Starlink as a standalone business, analysts estimate it would be worth between $120 billion and $200 billion on its own. So what's the problem? The problem is everything else they stapled to it. When SpaceX merged with xAI, they didn't just add a revenue stream. They added a $6.355 billion annual operating loss. xAI is burning money at a rate that would make most companies nervous. In 2025, the AI segment consumed $12.7 billion in capital expenditures. That's the cost of building physical infrastructure to construct the Colossus GPU clusters in Memphis, Tennessee. In Q1 2026 alone, AI CapEx hit $7.7 billion. In a single quarter, the combined company's cash reserves fell from $24.7 billion at the end of 2025 to $15.9 billion by March 31, 2026. That's $8.8 billion gone in 90 days. If you annualize that, SpaceX is burning through cash at a rate of over $35 billion per year, and there's a debt problem hiding in the balance sheet. SpaceX carries $29.1 billion in total debt. Approximately $19 billion of that, mostly legacy debt from the Twitter acquisition and xAI infrastructure, matures in 2027. That means within roughly 18 months of this IPO, SpaceX needs to either refinance or repay $19 billion. In 2025, the company posted a GAAP net loss, the official audited accounting loss, of $4.937 billion. In Q1 2026 alone, the GAAP net loss was $4.276 billion. These are not small numbers, but here's where the story gets complicated, in a way that actually matters for your decision. At $1.75 trillion, SpaceX is being priced at 93.7 times its annual revenue. Let's put that in context. Boeing trades at 1.9 times revenue. Lockheed Martin trades at 1.6 times revenue. Even Palantir, a high-growth AI company that Wall Street loves, trades at around 35 times revenue. SpaceX wants 93.7 times. The only company in recent history that traded at a comparable multiple was Rocket Lab, and Rocket Lab trades at 91 times its 2026 estimated revenue. But Rocket Lab's annual revenue is roughly $450 million. SpaceX's is $18.674 billion. Sustaining a 90x multiple on $18 billion in revenue requires a level of growth that very few companies in history have ever achieved. So now you understand the bet. You're not betting on whether SpaceX is a great company. Everyone agrees it's a great company. You're betting on whether it deserves to trade at 93.7 times revenue on day one of being public. Let me give you the bull case first. because it's genuinely compelling. The bulls aren't looking at SpaceX as a rocket company. They're looking at it as a telecommunications infrastructure company, and they're comparing it to the beginning of the internet. The global telecommunications market is worth $2.18 trillion annually. Starlink currently has 10.3 million subscribers. For reference, AT&T has over 100 million wireless customers in the US alone. The ceiling here is not 10 million subscribers. Starlink's direct-to-cell service, a technology that lets your regular smartphone connect directly to a satellite, no special hardware needed, is already live on 7.4 million unique mobile devices across 30 countries. That's not just competing with satellite internet providers. That's competing with every phone carrier on Earth. And there's a number in the maritime business that should stop you in your tracks. Starlink's maritime customer base, ships at sea using satellite internet, grew 7 times over in 2024. That's not 7% growth. That's 700%. Over 75,000 active vessels are now paying for Starlink. Then there's Starship, SpaceX's next-generation rocket that's still in development. Currently, launching 1 kilogram of cargo into orbit costs thousands of dollars regardless of which rocket you use. SpaceX's internal target for Starship is $10 to $100 per kilogram. That's not an incremental improvement. That's a 100x cost reduction, if they can pull it off. And then there's the wildest part of the bull case: orbital AI data centers. Starting as early as 2028, SpaceX plans to launch satellites that function as solar-powered computing clusters in space, basically data centers orbiting the Earth. No land, no cooling costs, unlimited solar power. If that sounds like science fiction, remember that Starlink itself sounded like science fiction in 2015. If Starlink captures just 5% of the $2.18 trillion global telecom market by 2030, that's $109 billion in annual revenue from that one segment alone. Apply a software multiple of 15 to 20 times, and Starlink alone is worth between $1.6 trillion and $2.2 trillion, which means you're getting the rocket business, the AI company, and Elon Musk's personal relationship with every major government on Earth for free. That's the bull case. Now let's talk about the bear case, because this is the part most people skip when they're excited. Let's start with a story you might know. Virgin Galactic. In 2019, Richard Branson took Virgin Galactic public through a SPAC at $10 per share. The stock peaked at $60 in 2021. Today it trades at $2.17. That's a 95% decline from peak. Or Rivian, an electric truck company that IPO'd in 2021 at $78 per share. Day one, it closed at $100. Today, it trades at $8.60, a 90% decline from peak. Now, SpaceX is obviously a different company than Rivian or Virgin Galactic, but the pattern matters. According to historical data from FactSet and Edward Jones, the 30 largest IPOs in the last 20 years have underperformed the S&P 500 by an average of 15% in their first year. Not outperformed. Underperformed by 15%. And here's the mechanism that makes that happen. When a high-profile company goes public, institutional investors, the big banks and hedge funds, get access to shares at the IPO price. When it pops on day one, they sell to retail investors buying at the peak. Data shows that high-profile IPOs see an average first-day pop of 18% to 24%. That sounds great, until you realize you're usually the one buying after the pop, not before it. Now let's talk about RPU. Starlink's average revenue per user has dropped from $99 to $66 in 3 years. That's the company's own data from the S-1 filing. SpaceX says this is intentional, they're buying market share. But Amazon's Project Kuiper, once it launches commercially in late 2026, has every incentive to price aggressively to steal those subscribers. Amazon can afford to lose money on satellite internet for a decade. If RPU keeps falling under competitive pressure, The math that makes Starlink look like Apple starts to look a lot more like a standard telecom company. And then there's the Elon problem. The S1 explicitly states that SpaceX does not carry key person life insurance on Elon Musk. The company literally wrote in its legal filing, "Our business depends heavily on this one person, and we have not insured against losing him." Beyond that, Musk runs Tesla, XAI, the Boring company, and has a formal advisory role in the federal government. That's 5 major commitments, and SpaceX is one of them. How much of SpaceX's $20 billion in cumulative government contracts was won because of Musk's personal relationships in Washington? That's not a rhetorical question. It's a real risk factor in the S1. So let's make this personal with 2 hypothetical investors. Meet Jake. Jake is 34, lives in Austin, has a solid 401k, and has been watching SpaceX news for the past 5 years. He's been waiting for this IPO like it's a concert ticket that finally went on sale. The moment SpaceX starts trading on June 12th, Jake buys $5,000 worth at whatever the opening price is. He doesn't care if it pops 20% on day 1, he just wants in. Jake's reasoning: "This is generational. I am not missing this." Now meet Marcus. Marcus is 36, also in Austin, also watching. Marcus reads the S1. He sees the $4.28 billion quarterly net loss. He sees the $19 billion debt wall coming in 2027. He sees the 93.7x revenue multiple. Marcus doesn't buy on June 12th. Marcus sets a price alert and waits. 6 months later, after the initial IPO euphoria fades, the stock has pulled back from its opening day high. Marcus buys $5,000 at a lower price, with more information about how the first 2 earnings reports went. Who made the smarter move? Historically, the data favors Marcus. But here's the uncomfortable truth. If SpaceX is the rare exception, if it's the Palantir of this generation, which went from $9 to $152, Jake wins. Palantir is currently up over 500% from its IPO price. The question is not whether SpaceX is a good company. The question is whether you are buying a good company at a good price. And at $1.75 trillion on day 1, that is genuinely hard to argue. Here's what I think you should actually take away from this. First, your retirement account is already buying SpaceX whether you like it or not. Once SpaceX enters the Russell 1000 and eventually the S&P 500, every index fund on Earth has to buy it. That's not your choice. It's structural. Second, Starlink is a real business with real profits. $7.168 billion in adjusted EBITDA is not a meme. The problem is that XAI is burning through that profit and more. Third, the $1.75 trillion valuation assumes SpaceX successfully executes on Starship, scales Starlink to 100 million subscribers, builds orbital data centers, and wins the AI race, all at the same time. That's a lot of bets to make simultaneously. Fourth, and most importantly, the best time to buy most IPOs is not day 1. It's after the euphoria settles, when the actual fundamentals start to matter again. Think about Airbnb. It IPO'd at $68, popped to $144 on day 1, and today trades at $134. If you bought on day 1 at $144, you've lost money 5 years later. If you waited 6 months and bought at $105, you're up. The company didn't change. The price did. So picture yourself 10 years from now. In one version, you bought SpaceX at the IPO peak, watched it drop 40% in the first year, held through the volatility, and came out the other side when Starlink hit 50 million subscribers. In the other version, you waited 3 months, bought at a more rational multiple, and enjoyed a smoother ride to the same destination. The destination might be the same. The experience of getting there probably won't be. This week, if you want exposure to SpaceX before the IPO settles, look at the funds that already hold it: PRIVX, DXYZ, or ARKX. This month, read the actual S1 filing. It's public, it's free, and the risk factors section alone will tell you more than any analyst on television. And when SpaceX starts trading, remember, the question is never whether the company is great. The question is always, at what price? That's why I built this channel, because the most important financial decisions of your life get decided in moments of hype. And hype doesn't care about your retirement. The math does. If this video helped you think more clearly about the SpaceX IPO, I'd really appreciate a like. It genuinely helps more people find content like this before they make a decision they'll regret. And if you enjoyed this video, be sure to subscribe and stay tuned for more videos. See you there.